Division 34, corporate wardrobes and uniforms. Clothing expenses are private and therefore not deductible. Normal clothing that people wear is what we call conventional clothing, and as such it's a private expense which cannot be deducted. There are some exceptions to the rule. For example, Mansfield's case, where the flight attendant was allowed to claim the cost of shoes, pantyhose and moisturising creams. Edward's case, the vice-regal officer's wife, who was allowed to claim for clothing because she had to have a lot of different changes of clothing each day. So she might have had 3 or 4 different appointments during the day, and they all required different outfits, so she was allowed to claim that. So with the exception of those very extreme cases, clothing as a general rule is not deductible. Uniforms, however, are deductible if they qualify as a uniform. So the first thing we need to do is look at what is a uniform. And that's defined in 34-15. And a uniform is clothing which distinctly identifies someone with their employer. Now, there are some really easily identifiable uniforms that don't even need a name on them, and you know that they're a uniform. So, for example, a nurse's uniform, you look at them and you know that that person is a nurse. So it doesn't need anything written on it saying such and such hospital for you to know that it's a uniform. Things like chefs' black and white trousers are uniforms. So there's no problem with deducting those. If something is protective, so steel cap boots, goggles, safety goggles, aprons, overalls, things like that, where they're protective, they are also deductible, and they are not considered to be private because they're fulfilling another function. The issue arises in relation to things like non-compulsory clothing. If the uniform is compulsory, then, and it's still not, conventional clothing, then the cost is deductible. So what sort of things are we looking at here? You need to be very careful, because sometimes an employer might say, we want you to wear black trousers or a black skirt and a white top. Now, even though it's very specific that you're wearing black and white, it's still conventional clothing, because the black skirt or the black trousers can be worn outside of work, and they don't draw attention to the fact that that person is working in a particular industry. Similarly with a white shirt. So when it's something very general, like just a particular colour, then even though it might be compulsory, it's still conventional clothing, because you could actually take the person out of that work environment and they could wear whatever it is, and you wouldn't be able to distinctly identify them as working for that particular employer. It might be very different if the employer had something very specific that when they did walk down the street, it would identify them, but we're not going to go into anything that detailed at this stage. Where we do have an issue is with what we call corporate wardrobes. If you go into some banks, insurance companies, and certainly if you fly on some airlines, the staff wear a particular uniform. Now, this uniform doesn't have the name of the bank or the name of the insurance company, but when you look at those people, you are aware that they're wearing a uniform of sorts. There's a particular pattern in the fabric, there's a colour scheme that goes through the whole thing. And these are called corporate wardrobes. These corporate wardrobes are generally not compulsory within the entire organisation. So what you might find is the counter staff have to wear them. If they are not compulsory, to be deductible, they must be listed on the specified register. And if I was going to give you a question like that, I would state that it was a non-compulsory uniform listed on the register. You can read more about that in your Master Tax Guide. We now come to this issue of prepaid expenditure. You might remember, going right back to topic 1, that if someone received income in a lump sum, but provided the service over a period of time and accounted for it as unearned income until the service was provided, then the person receiving that income was only assessable on the income when the service was provided. So for example, if a business owner received 10 years of prepaid management fees and they were received at the end of June, just in time to get a nice big tax deduction for the payer before the 30th of June, that income would not be assessable in full to the payee, the person who received it. However, the payer, by paying the 10 years of management fees, would have incurred the expense, and therefore the full 10 years would have been deductible. So what you had was a gross imbalance between income received and how much was assessable, which was very low, and the amount of the deduction claimed, which was very high. These two particular areas were used by very creative tax planners to ensure that you had one group of taxpayers who got a really big tax deduction, while the people receiving them only returned the income over a period of time. This led to a bit of a rorting of the system, and so eventually the law has been changed. Now, if you understand what this section is trying to do, it makes it really easy to apply. What it's trying to do is it's trying to balance the deduction with the assessable income of that year. So basically what this section says is if you prepay an expense, then you must only claim the amount of that expense which relates to the current year. So if you look at 82 KZL, it talks about the who the section applies to. Then it goes on to say, if you're in that position, what you can claim is the amount of the prepayment. How much did you prepay? Multiplied by the number of days that it reflects in that year over the total period of the repayment. So what it's doing is it's saying, well, if you prepaid 2 years of rent on the 1st of June, because the person receiving it is only going to say, well, I've only derived 1 month's worth of rent, the payer can only claim 1 month of deductions. So if you had a large, whatever the payment was, the amount of the prepayment, you would multiply it by 30 days over 730 days, being the 2 years. So it works on the amount of the prepayment that is made. Now, there are exclusions to these, and the main exclusion applies to SBE taxpayers and non-business taxpayers. So non-business taxpayers would be owners of rental properties, or the owner of a share portfolio who's borrowed money to buy the shares in that portfolio. Those two categories of taxpayers are allowed to prepay up to 12 months, providing the prepayment finishes before the end of the following year. So, for example, if your taxpayer was an SBE taxpayer and they paid their rent monthly, so July, August, September and so on, they did their figures in about May and thought, gosh, we're going to make lots of money this year, how can we drop our profit a little bit? What they might do is decide to prepay on the 1st of July, on the 1st of June, 2 years worth of rent. The landlord might be quite happy and say, well, look, I'm sorry, not 2 years, let's just make it 1 year. The landlord might say, well, yes, I might even give you a little bit of a discount on that because I'm getting all the money up front. What happens is the landlord is, of that 1 year's repayment, the landlord will only have derived 1 month of the prepayment. So the landlord has, of course, derived the rent for July, August, September and so on. Of the prepayment made on the 1st of June, the landlord has only derived 1 month of that. And then the SBE taxpayer would take, let's say it was $1,000 a month, so the prepayment is $12,000. It would be multiplied by 30, being the 30 days of June, divided by 365. The SBE taxpayer, in addition to the payments from July to May, would be able to claim the full year's prepayment. But that is the only exception that's allowed. If, on the other hand, the SBE taxpayer prepaid for 2 years, then the apportionment requirements would apply. So the SBE taxpayer would only be able to deduct 1 month out of the 2 years of the prepayment. So for SBE taxpayers and non-business taxpayers, there is scope in there to use this prepayment section. However, once SBE or non-business taxpayers get past that 12-month prepayment, or it finishes after the end of the following year, then they must apportion the amount of the deduction. There are some exclusions for payments under $1,000, payments for salary and wages and so on, but apart from that, the basic rule is that the Tax Act is trying to balance the income with the expenditure. So if you understand that and bear in mind the exclusion that applies for 12 months or less, finishing before the end of the following year, which applies to SBE taxpayers and non-business taxpayers, then you will have understood this particular section. Self-education expenses. Self-education expenses are deductible under Section 8-1, providing there is the link to the deriving of assessable income or are necessarily incurred in carrying on a business. However, if you can't find that link, so for example, here we have a number of students who work perhaps at the tax office or work in accounting firms, and they are required to study a commerce degree. Obviously their self-education expenses are deductible. But we have other students who work as wait persons in restaurants and cafes, or they might work in a supermarket to earn some money, and they're studying a Bachelor of Commerce. Well, there is no link between earning the income and deriving that expense, so they cannot deduct their self-education expenses. So the first thing is that self-education expenses to be deductible, must be incurred in earning that income. Now, the problem areas that occur relate to this restriction under Section 82A. And 82A says you can only deduct the expenses above $250. So as a very simple example, if the self-education expenses came to $750, you could only deduct $500 because you would take $750 minus $250 and you would get $500. That's at a very simple level. However, that situation has now become a little bit more complicated, and I'll show you how that works. The first thing is that for this section to apply, it applies in respect of a prescribed course of education. So we need to work out what is a prescribed course of education. Have a look, while I'm talking about this, get your legislation out and find the section and have a look. A prescribed course of education is a course of education provided by a school, college, university, or other place of education, and undertaken for the purpose of gaining qualifications for use in carrying out a profession, business, trade, or in the course of any employment. So it's a course of education at a school, college, university, place of education in relation to basically to your income earning activities. So if it's not a place of education, this section doesn't apply. If it's not in relation to getting a qualification, this section won't apply. So simply because a question says self-education, students instantly jump into this section and think it must apply. But it only applies if you meet those requirements. So what sort of things would not apply? The courts have held that the Institute of Chartered Accountants, the professional year studies there, do not qualify because the institute is not a place of education. That is, while it provides education, that is not its core function. If someone did a small course, a 5-day course or something like that, that is not a course to gain a qualification. So what we're talking here, things like an MBA, a Bachelor of Commerce, that sort of thing. So make sure you understand that first of all. What does it apply to? And some other examples were that places that were places of education, a 6-week course 3 times a week for an apprentice butcher, that was considered to be a place of education. Let's look further at the section, and it goes on to define what are expenses of self-education, and it specifically excludes HECS. So if what you're paying is your portion of your government-funded place at a university, then that is not an expense of self-education. So we just completely remove it from our equation. Now, having got through all that, we've now said this is a course of study at a place of education to gain a qualification. 82A will apply. If 82A applies, what you need to do is work out your deductible and non-deductible expenses, and what you can do is you can use your non-deductible childcare expenses, your non-deductible self-education expenses to make up that $250, thereby leaving more of your deductible self-education expenses to be deducted under 8-1. So let's have a look at this example, the university lecturer studies for a higher degree. And we have travel to and from home in the evening, books, computer discs, photocopying stationery, childminding, second-hand printer. We work out the deductible expenses and the non-deductible expenses. Once again, remember at this point, that it's very important when you exclude items in your exam that you give us reasons for excluding the item. This is particularly important to those students who aren't on campus, because on campus the lecturers really stress these. But if you're doing this off campus, you haven't got someone stressing this, so please remember that you must do this. So, for example, you might say that you must say that the childminding is private. You must say that the second-hand printer is capital. Don't just say not deductible. I can't tell you how many papers I mark, and I have to keep taking marks off because people write not deductible. Give a reason for excluding the item. Now, what we can do in this example, the deductible expenses are $620. We don't want to take the $250 off the $620. Here we're lucky, we've got $255 of non-deductible self-education expenses, so we use those, we apply those against our $250 threshold and take that off. So we've used up that threshold and we can deduct the full $620. What if I said to you that with that lecturer, what if the lecturer didn't buy the printer? How would your answer change in that question? See if you can work out the answer to that. Now, what would be your deductible self-education expenses? The other thing we need to do before we leave self-education is we should talk about the travel costs of self-education. If you think about it, let's look at a student who's working part-time in an accounting firm and is required to do a Bachelor of Commerce at Curtin. Because the person's working part-time, that student doesn't go to work every day. So let's say we look at Monday and the student travels from home to Curtin, does some classes, does some study in the library, and then drives home again. The cost of driving to Curtin is an expense of self-education and is fully deductible. The cost of getting home again is also an expense of self-education, because having got here, you have to go back home again. Let's say now on Tuesday that student travels from home to Curtin for a morning lecture. The cost of getting from home to Curtin is an expense of self-education and is fully deductible. The cost, however, of getting from uni to work after that lecture is a private expense. It is the cost of getting to work. Let's say now that that student works till 5 o'clock and then drives from work to Curtin for an evening lecture. That trip is deductible. It is an expense of self-education. Think about it. Where are you going? Why? You're going to uni for the purpose of your study. And then from uni, that student goes home. That is a private expense because, remember, the cost of going from work to home is private, and that stopping off at university was just an interruption to that. So the cost from uni home becomes a private expense. If the student on Wednesday drives to work in the morning, we know that that's private, then drives from work to uni and back to work, that is a self-education expense, and that is deductible. You'll see these scenarios set out in your unit guide. Have a look and review these issues. We now come to divisions 280 and 290 regarding superannuation. And basically superannuation is quite simple now. An employer or a self-employed taxpayer can deduct the full cost of superannuation contributions. For those of you who might be repeating, we had things like age-based limits in the past. They have all gone now. So it's simply a case the employer, whatever the employer pays, whatever the self-employed person pays, is fully deductible. A self-employed person can deduct their contributions as long as they're not getting more than 10% of their assessable income from salaried income. Employees cannot deduct the cost of their own superannuation. So for example, I have a Curtin superannuation fund. If I also had a private fund and I contributed to that private fund, I couldn't deduct the contributions to that private fund because I am receiving superannuation support from someone else. Don't forget that all employers are required by law to contribute 9% superannuation on behalf of their staff. So all employees are receiving superannuation support from someone other than themselves, which is their employer. Therefore, they cannot also claim any private superannuation that they might contribute. Losses are contained in Division 36, and I have to say that losses cause students a huge amount of problems. And the problems arise because students try to do everything in one hit instead of separating the issue of losses into a number of parts. Let's look first of all at the definition of a loss. Section 3610 says that a loss is derived calculated by deducting expenses from ignoring carry forward losses from assessable income first and then exempt income. So the first step is, in the current year, have I made a loss? So you look at your expenses, and if your expenses are greater than your assessable income, then you need to say, oh, do I also have exempt income? Am I a member of the Army Reserve or something like that? And if the person is, then you also take that exempt income into account. And any remaining amount is a loss. So if you look at the example, you'll see that we have income from the sale of TV sets 10, expenses of 15, and there's an exempt pension of 3,000. So our starting point is our expenses of 15, take 15 from our income of 10, so we're in a loss of 5. However, because we have exempt income of 3, we can offset the 3,000 exempt income against that loss of 5,000, so we only have a $2,000 loss. Whereas when we first looked at it, we said, oh, our business has made a $5,000 loss, but we use the exempt income to reduce the amount of that loss. So that's the first thing. What is the loss of the current year? And read the section. It specifically says, forget about carry forward losses for now. Leave them out of the picture. Let's just work out the current year loss. We next need to look at how do we offset that loss in a future year. Now this section says that if you have, in 3615, if you have losses that you're bringing forward, how you offset them depends on what sort of income you've got in that year. If you only have assessable income, well, obviously you offset the loss against the assessable income. So again, in the following year, you take assessable income minus your deductions. If you've got assessable income left, then you bring forward that loss from the previous year and offset it. However, if you have exempt income, you take the loss first against the exempt income and then against the assessable income. It's so clever, isn't it? Because that way you pay more tax. So where students get mixed up here is they try and do everything in one. So firstly, work out your loss. Then bring your loss forward, but before you offset it, work out what's happening in the current year, income less expenses. If you're in a profit situation, so you've got assessable income left, then bring your loss forward and offset it. If you've got exempt income, first offset it against the exempt income, then against the remaining assessable income. And I've done an example for you on this as well, and you'll see how we've offset it. First, we've calculated the loss for the current year, and then in the next year, we've offset $3,000 of the loss against the exempt income, leaving us with $1,000 to be offset against the assessable income. Now, 2655, so you go through that and you think, oh, that's pretty simple, and I can work that out. Where it does get a little bit complicated is 2655. And 2655 puts a limit on your carry forward loss. And this is something, if you're working in the area, you need to think about, because you actually wouldn't want to be incurring a lot of these expenses if you're not going to benefit from them. 2655 basically says that personal superannuation, donations, and things like pensions and gratuities to staff and former staff cannot increase a loss or cannot create a loss. What does that mean? What it means is this: if your income was $10,000 and your expenses were $15,000, you are already in a loss of $5,000. If in addition to those expenses you had paid personal superannuation, you could not deduct that personal superannuation because it is increasing your loss. It's taking your loss from $5,000 to something much greater. If, on the other hand, your income, say, was $20,000 and your expenses were $18,000, so you've got a $2,000 excess of assessable income, and you paid personal superannuation of $5,000, you can't deduct the full $5,000. You can only deduct the $2,000 to take you down to zero, because you can't create a loss. You can't go from a profit of $2,000 to a loss of $3,000. You can go from a profit of $2,000 to zero, but you can't go into a loss position. So if you remember that those three expenses cannot increase a loss where you're already in a loss, or cannot create a loss where you were in a profit and now you're going into a loss, then you'll be fine. Once again, we've got an example for you. And if you look at that example, you'll see that we can't create our loss or make our loss any bigger. Trading stock is pretty simple, and yet it causes a lot of problems with students. If you go back to first year accounting, remember your trading stock equation, which was opening stock plus purchases less closing stock. Well, that's exactly the same for tax purposes. The only thing is, we need sections that tell us what we can do. The sections allow us to do what we've been doing from an accounting point of view. So you'll see the sections that say that if your closing stock is greater than your opening stock, this is under 70-35(2), the excess is included in your assessable income. And in 70-35(3), it says that if your closing stock is less than your opening stock, then you deduct the difference. Students get really concerned with this, and there is no reason for concern, because all it's doing, remember, the purchase of your trading stock, which is purchases, is deductible. How do you take into account the opening and closing stock And that's all that those sections are saying, that you would get more of a deduction or less of a deduction. So don't worry about it, just do what you did right back in first year accounting. Opening stock plus purchases less closing stock. There are some slight differences. For tax purposes, you can value each item of trading stock at a different value. You can use market selling value, cost, or replacement price. In terms of cost, how do we work out the cost of an asset? And once again, the Commissioner has given us a definition, the Commissioner rather has given us a list of what is acceptable, and within that he allows us to use weighted average, first in, first out, and I've forgotten the other one. You'll have to look it up in your book. So have a look at the examples on trading stock. Really, we don't take it to any great degree in this course. Now that we've finished topic 2, the way you should be able to deal with deductions is this. You look at an expense and you say, is this incurred in earning assessable income or necessarily incurred in carrying on my business? If the answer is yes, then you need to think, is it excluded because it's capital or private or whatever, or is it excluded because a specific section tells me that I can't claim it? If you say, no, it's not incurred in earning my income or necessarily incurred in carrying on my business, or it is excluded under one of the specific sections like it's a capital expense, you then need to go back and say, but is there a specific section that allows me to deduct it? So while we know that borrowing expenses are capital, while we know that some business expenses are capital, we've got 2525 or 40-880, which allows us to deduct them over a period of time. So you need to learn to work your way through that way of thinking and then apply it to each particular circumstance that you come across.